Welcome to Daily Trader. I'm Tom White right here on the Schwab Network, where we're going to break down a couple option strategies and a couple names that you might recognize. We'll give you all the guidelines, the risk-reward profiles, some of the levels that we're looking at, what the stocks have done for the year before we dive into this. Try to give you an understanding of how we look at these strategies on a daily basis and how to offset risks and stay in risk defined. First name we're going to look at today is Tesla. I think it's had a pretty good run here over the last couple of months, up 38% in November, up 20% so far in December into the end of the year here, giving up some of those gains from all-time highs that we saw earlier in the month. But this has been on the back of the Trump trade. A lot of expectations that deregulation is going to come into play. And not only in the EV space, but some of the other parts within Tesla. It's going to be a bonus for him. And that's the optimism and why the stock's up 67% so far in 2024 as we wrap up and head into 2025. One of the key things to note going into Tesla is January 2nd deliveries, the day after New Year's. Expectations of about 510,000 cars delivered in Q4. So we'll have to wait and see on those numbers. But what does that mean? Well, it means implied volatility levels are expanding going into a potential market-making move. And what does that do when implied volatility levels go up? Option premium expands. So selling strategies in this type of name with the expectations that whether you're bullish, bearish, or in this case, the example trade we're going to look at is neutral and trying to take advantage of that high implied volatility going in to that delivery numbers on a short-term position trade here in Tesla. So I went out to the January 3rd weekly cycle, expires in just 3 days. IV percentile rank of about 76% right now. So it's in the top 3/4 of implied volatility levels that we've seen over the last 52 weeks. So we want to take advantage of that. And the strategy I'm looking at is a short iron condor. It's a neutral strategy where you're selling an out-of-the-money call vertical and an out-of-the-money put vertical to the downside to take advantage of the high IV with the expectation that the stock's not going to move that much into the end of the week. So in this strategy, January 3rd weekly, we sell the 445 strike call and buy the 450 call. There's our short $5 wide call vertical that's neutral to bearish. And then on the put side, we're going to sell the 405 strike put and buy the 400 strike put, short $5 wide out of the money put vertical. You combine those two short verticals to create this short iron condor. You collect a credit of about $2.30. So what does that mean my risk is? It's the $5 width of each one of those verticals minus the $2.30 that you can collect on this. So you've got about $270 in risk per spread on this type of strategy. Now, if I collect that $230, that's my max profitability on this trade as long as the stock remains above 405 or below 445 into the end of the week. You're taking advantage of that high implied volatility by selling those both out-of-the-money verticals on the call side and the put side. If I collect a 230 credit on this, as I said, that's the max I can make, but it widens out my break-evens on this one to about 402.70 on the downside and 447.30 on the upside. You can see here from the risk profile, I've got a pretty wide range for this stock to trade in over the next 3 days. And remember, one of those days is New Year's Day where the market's not open. So time decay is working in my favor also on a short strategy such as this. The options market is pricing in about, I'd say probably about a $24, $25 move into the end of the week. But this takes advantage of some consolidation post that deliveries report. Now, if you think the stock's going to move on that deliveries number into the end of the week at expiration, then you don't want to do this type of strategy. You only want to do this type of strategy in Tesla if you think it's going to be range bound. You're taking advantage, as I mentioned, of that high implied volatility, which allows you to collect more credit on this short iron condor. So this is one of those strategies. It's a neutral strategy. We always talk about bullish and bearish directional plays. This is also a direction. It's a neutral strategy. You just don't want the stock to move maybe more than one standard deviation to the upside or downside to take advantage of positive time decay, which works in your favor as you get closer to expiration. As long as it's between those break evens, the price of this iron condor is going to contract in value, allowing you to let it go out worthless or potentially buy it back cheaper than the $2.30 that you collected on it. All right, so good look at the neutral strategy there in Tesla. The next stock we're going to take a look at is Microsoft. This has been a laggard out of the Mag 7s. It had a good start to the year, hit all-time highs in July of about $468, but it's been on a downturn lately. It's been consolidating in a range, pretty tight range. It's right about its 50, 200-day simple moving averages. That's become a base for this stock recently, around this $420 to $425 level. They do report earnings later in January on the 28th. So we want to look at a strategy that avoids that potential market moving event, which is earnings on this one. Now, we talked about high implied volatility in Tesla on the last example, right? Well, in Microsoft, it's the opposite. The IV percentile rank, which you can find under option statistics on the Thinkorswim trading platform, is at about the 35% level. So it's in the lower end, about 1/3 of what implied volatility levels have been over the last 52 weeks. So what does that allow me to do? Well, maybe long verticals as opposed to short strategies that try to collect credits. This is going to be a debit type of bullish call vertical that I'm going to look at if you have the expectations that Microsoft's going to go higher into that earnings event. But we've got the January 24th weekly options is where we're doing this vertical. So you're going to avoid the event risk, right? This allows you to take advantage of a potential move to the upside prior to earnings. Sometimes we'll get some revisions from the analysts on this one. So going out to that January 24th weekly cycle, you've got about 24 days till expiration in this one. You're going to avoid that earnings event. As I mentioned, you're going to buy the 425 strike call that's basically at the money. And then against it, because I want to offset some of my risks. There's some there's some decent option premium in those long 425 calls. I want to offset some of the risks, but that's going to limit my profitability, but it's going to also lower my break even and the amount of I have risk on this bullish trade. So I'm buying the 425 strike calls, selling the 440 strike calls. A bullish $15 wide call vertical to the upside. I'm going to pay a debit of $6 on this, around that level. So if I pay $6, I've got $600 in risk on every spread that I do. Now, what can that expand to? Well, it can expand to $15 if the stock goes above 440 at expiration over the next 3.5 weeks, 24 days. So if I pay a $6 debit for this 425, 440 bullish call vertical, my break even to the upside where I start seeing profitability at expiration is going to be $431. So about $6.5, maybe $7 above the current share price. That's only about 1.5% above the current share price in Microsoft. So you don't need a monster move to the upside in this one to take a directional bias on Microsoft. As I mentioned, the IV percentile rank only about 35%. So that allows me to pay less for a directional type trade such as this vertical. Now, what type of delta do I have on this? And it's a delta of about 25. So for every dollar move in the stock higher, the price of this vertical is going to expand by 25 cents. But as the stock moves higher, the delta is going to grow on this type of strategy. So it's a bullish trade. You're looking for a directional bias here by buying the 425 calls, selling the 440 calls. So good look at if you think that Microsoft's going to go higher into that earnings event while avoiding the earnings event, this strategy definitely takes advantage of that. But you need a 1.5% move to get above that break even of 431. All right, that's going to wrap it up for me. A couple of decent trades there in Tesla neutral, Microsoft bullish as examples. That's going to do it for me today here on the Daily Trader. Watch Schwab Network 24 hours a day on schwabnetwork.com and make sure you download the Schwab Network app.